Hello everyone, welcome to Blue Dragon Actual. So today we are going to study this topic about what happens when policyholder cancels a policy. This is one of the question that came up in my interaction with my colleagues in my office, and they had some confusions. And I thought, while discussing this topic, I thought this is a very good, topic to discuss in my for my own YouTube channel. So the question is, what happens when policyholder cancels a policy? Now, the first thing that might come to your mind is, can policyholder cancel a policy? Like, after the policy is issued, can the policyholder cancel a policy? So that is the this is the question, right? So obviously the policyholder can cancel a policy, and the insurer is allowed a period of 15 days if it is issued in physical form, and 30 days if it is issued in electronic form. And these days, like after the COVID, the policies are getting issued in electronic form. And I heard there was something called dematerialization. The policies are getting dematerialized, they are being stored the same way the stocks and the shares are stored, right? So I think that is also going on. In fact, one of my own life insurance policy was like that point of time, it was not mandatory. I don't know if it is still mandatory, but when I was working in SBI Life, then it was there was a thought process that it would be made mandatory, and SBI Life went into a agreement with NSDL, and my own policy is kind of stored in NSDL, a term policy. So in electronic form, it would you will get a time period of 30 days, and that is called free look cancellation, also known as FLC. If you have worked in insurance sector, you will know that it's called free look cancellation. And this varies depending on country to country. In Canada, it is 30 days. In some other country, it may be 45 days. So number of days is not important here. In India, obviously, it's 15 and 30, as I mentioned. This is taken from IRDA regulations. So number of days is not important, but what is important is, yes, even after the policy is issued, as you can see, right, the policy is the policy can be like the policyholder may try to review the terms and condition, and if the policyholder finds the terms and conditions are not satisfactory, the policyholder can cancel a policy. And even if, and we'll see in the like in the we'll see in the course of this presentation that there would be some places where policyholder would not, although the policyholder take that reason that it is cancelled for terms and condition, but it may be something else, right? So obviously, in this case, the policyholder are issued the policy, right? And once the policyholder receive the policy bond, then the policyholder review the terms and condition. So policyholder already, like, the insurer has already accepted the risk for the policyholder, and even then the policyholder can say that I don't require this policy. And that's why there is a time period given, because it cannot be 1 year, right? Because then that in that time period, anything can happen to the policyholder, and insurer is liable to pay. So that is a minimum time period that is given. Like, even after everything is done, if you are not happy with the terms and condition, you can still say that I don't require the policy. That is called cancellation. And that is not called surrender, because nothing, you will pay nothing if you take that terms and condition. Only your premium that you have paid will be repaid, right, after deduction of some charges. Moving on, why this happened, right? This is the most important thing, why this happened. First of all, mis-selling. So I have heard of cases, like when I was working in core companies, I've heard of cases that term policies are sold as saving products. Sometime ULIP is sold. Like, in ULIP product, there are two components: maturity benefit and say, the death benefit. So death benefit is usually much higher, and in that, the initial phase. So for example, the death benefit might be, say, 50 lakhs, but maturity benefit will depend on the, at the time of maturity, what is the fund value, right? So that might be less than 50 lakhs, right? And people or agent sell the policy saying that your benefit would be 50 lakhs, and you just have to pay maybe 10,000 per month, or 10,000 per year. And people think that, okay, this is how it is, and then they later realize that no, that is that benefit, and what I'll get if I survive the entire term would be maturity benefit. Both are different, and that's how they are kind of sold. So many times we have seen protection product sold as saving product, and that's why IRDA has, I mean, has been very hard on the agents for this mis-selling. It was a very big problem in 2005, 6, 7, especially when the insurance market was booming, and the stock market was also booming before the 2008 crash. So every ULIP policy, almost every insurer has most missold product knowingly, and they have sold the ULIP policies, because at that point of time, everything in the market was going up, and ULIP was performing very well at that point of time, and people has missold product. That's why IRDA is a bit hard on the insurer. Even after like long time have passed after that. Anyways, there are a lot of regulations on the charges of ULIP policies, which I personally feel is bit unfair. But I mean that is made by the IRDA because of those mis-selling, right? So insurer has dug their own grave, but that they had done much before. Like the management has changed, everyone has changed, but IRDA is still pretty hard on the insurer. Once again, as I mentioned, policyholder is not happy with the terms and conditions. So this is the real reason for an FLC or free look cancellation. If policyholder is not happy with terms and conditions, they can cancel the policy. An arrangement of the advisors to win targets like MDRT. So there is some, sometimes there are some competitions or promotional events or some bonuses that are extra bonuses that are given to the salesperson. MDRT is very prestigious, called $1 million roundtable conference. So every agent who have sold more than 1 million policies, like the gross premium is more than 1 million, they and their family are sponsored by the insurer, and they go to, I think, US. I don't remember the country now, but I think they go to some other country, and it is a matter of big prestige for them that they are sponsored by the insurer to kind of go to that place, and there would be 1 or 2 day conference, and they will enjoy the hospitality there. So sometime what agents does is, if they are very close to that 1 million mark, right? Maybe they are at 990, and they want their, sometime they have some contacts or some big personalities, HNIs, etc., where whom they contact and say that can you purchase this policy so that I'll fulfill my target. And after purchasing the policy, maybe within 15 days, you can cancel this using free look cancellation, and you will get your premium back, right, after deduction of some amount, and that amount that will be deducted, I'll pay that to you, right? So that has happens, and hence the commission clawback or renewal, etc., right? So all those, like, the more the more evolved the treachery becomes, the more evolved the thing to contain those treachery also become, right? So that's how people react. But these are ways through which people kind of try to win those competitions, and that also is a major reason for MDRT. So in this case, the policyholder will still tick that they are not happy with the terms and condition, but that is not the real reason, right? That's a that's a pre-arrangement with the advisor, right? So these are the reasons for which this happened. Now, what happens when an insurer receives a policy, right? First of all, insurer examine it at pre-underwriting stage. Usually, there would be a pre-issuance department who would make calls that we have received your promotion proposal form. Are you aware of this? Just to ensure that someone has not forged someone's signature and just put the money there just to maybe fulfill that target that salesperson have. So that pre-examination would be there, right? Then obviously there will be underwritings where your financial detail, your medical details, everything would be kind of examined. This is the bigger stage, right? In operation department, like insurance can be split into operation, like majorly operation, marketing, finance, right, actuarial. So operation, the major department of operation would be underwriting, and another department will be policy servicing. These two are the major department because I initially started my career in operations, so I understand all of this. So in underwriting, they would examine their policy depending on the sum assured, if the medical, uh, as per your, like, whether you are a substandard life, whether you're standard life, whether you smoke, overweight, etc., etc., right? What are your financial capabilities? Can you pay the premium? All those would be examined in underwriting. So underwriting is the stage where the policyholder rates the risk and accept the premium or charges the premium according to that risk. So if you are regarded as a higher risk, you will be charged more premium for the same sum assured as compared to someone who is regarded as a lower risk, right? So that's, and there is bands, and actuarial are the person who kind of sets those band, but underwriting person kind of is responsible for making those premium assigned to a particular person or particular policy. So the main thing that happens is the insurer accept the risk. Like after underwriting, when the whatever risk you have been rated for, the insurer accepts the risk, right? So as soon as insurer has accept the risk, insurer has to set up reserve because it becomes an enforced policy, right? So even when the underwriting stage is over, even before the policy bond is, like, if by physical means, it would be delivered to you through courier. But if even before that, the insurer has accepted the risk, and that is why it has become an enforced policy. So insurer need to set up the reserve, right? The actuaries need to set up the reserve. So anything that is enforced, you need to set up the reserve from day zero. It's although we calculate in CT5 or CM1, we calculate the reserve at the year end, right? But the reserve is set just at time zero, right? T or zero plus. At time zero, it is reserve is zero, but zero plus there is some reserve, right? Whenever you have accepted the policy, you have to set the reserve. So what happens when a policy is cancelled? When a policy is cancelled, reserve is released, right? Obviously, because you have set up the reserve for that policy. So when a policy is cancelled through pre-look cancellation, you have to release the reserve, right? Now, releasing reserve is a positive cash flow for the insurer, right? We'll see the impact in much detail later on. But the insurer pay back the premium after deducting the expenses. So obviously, insurer has some expenses, maybe medical underwriting that the for which medical examination has to be conducted on the policyholder. That expenses, maybe some phone call that has been made, the policy paper that has been issued. All those expenses, there would be some charges that will be deducted from the premium. So if you have paid maybe 200 rupees, maybe 20 rupees is deducted, and you will be getting only 180 rupees even through fee cancellation, because the insurer have incurred some expenses to examine or assess your risk. That would be deducted, remaining premium would be paid off, right? And these are subject to audit. Insurer cannot like instead of deducting 20 rupees, insurer cannot deduct 100 rupees just to make profit. So insurer cannot make profit by this method. It will be audited, very strictly audited, and I mean they would be charged tremendous amount of penalty if, and they might be debarred from doing business, negative word of mouth. So no insurer will take that sort of a risk, right? Especially when, as I mentioned, IRT is so hard on the insurer. And obviously when the insurer pay back the premium, so this is a negative cash flow for the insurer. So insurer, and we'll see how the cash flows kind of tie up for and the impact on PNL, right? And later in the presentation. So right now you can understand, first of all, reserve is set. Then because the policy is cancelled, reserve is released, which is a positive cash flow. The insurer received the premium, but it also pay back the premium because of cancellation after deduction of some charges. Obviously that is a negative cash flow, right? So that's how it kind of like goes through after the free look cancellation. That's what happened in terms of cash flows, right? So is this a good thing for the insurer? That is the question, right? Because the reserve is released, right? So sometimes people confuse that. So this is of course not a good thing for the insurer, right? Why? That is because they retain only the expense they had paid for. The reserve, and we'll see the impact on the reserve bit later, so I'm not touch that right now. But they only retain the expense, right? They have paid 100 rupees, right? And they are only deducting that 100 rupees from your premium, and or in my previous example, they're only deducting the 20 rupees from your premium and paying you back the 180 rupees, right? So there is no loss, no gain for the insurer. So it's not a good thing. In that way, it is not also a bad thing, right? It's insurer is somewhere in the middle, but it reduces the embedded value, right? So at the start, when the policy you have got the policy, so you are expected to get future profit, right? The present value of future profit reduces because the policy goes away from the books, right? So that is only happening when the policy is written. I'm assuming that the policy is in profitable terms. The policy can also be written on non-profitable terms just to capture market. In that case, the embedded value will probably increase. But I am assuming that in this case, the policy is written on profitable term. So if the policy goes out of the book in maybe 15 days, so 15, if you compare the embedded value 15 days prior, then that embedded value would be higher, right? Because the present value of future profit decreases. So in that way, it's a negative thing for the insurer, right? Also, it may generate negative word of mouth, right? Due to mis-selling. Like if someone is genuinely missold a product, then that person might call off his relative and say that don't buy from this insurer. This insurer is a thief, or LinkedIn post tagging the insurer. We have seen that, right? So all of this would generate negative publicity for the insurer. No insurer does that. It reduces the value of the insurer. May not be on that year, on that time period, but overall on a future, if you consider the future as well, because insurance, especially life insurance, is a long-term business, right? And I'm talking about all of this from a life insurance perspective. So that will tremendously reduce the value of the business. Also, the other thing that happens is if the policyholder dies before the premium is returned, right? So when the policyholder is canceling, free look cancellation happens, then the policyholder is canceling the contract, right? That we have kind of studied in CT9. So if the contract is cancelled or the contract terms is not followed, then you have to pay the amount, right? So in this case, the policyholder is canceling the contract and the contract is not yet cancelled till the premium is paid back to the insurer. So if the policyholder cancels the contract and because of some operational delays and etc., the premium is not refunded to the policyholder, if that can be proved that the policyholder died maybe 1 day before the premium was received, then the insurer is still liable to pay the benefit, right? So in that case, the insurer and nobody will return the premium to the insurer then, right? And the insurer has to pay the death benefit. So that is a double whammy for the insurer, right? So that is a very rare scenario, although it's a very, very rare scenario. Like there will be a 1 in a million scenario, but if the premium is not paid back to the policyholder, then the insurer has to pay the claims, because technically speaking, they are still liable for paying the risk, right? And that contingent event has striked here. Moving on. So impact on analysis of surplus. Now, from actual standpoint, how it impacts the analysis of surplus. So if you don't understand analysis of surplus, I have already made 2 videos on that, and you can search my playlist for that SA2 playlist, or you can also browse through my videos. You can just type Blue Dragon Actuarial Analysis of Surplus. There are 2 videos that I've made to explain analysis of surplus. So I'll not go into detail of what analysis of surplus is. Just understand that analysis of surplus is the ultimate method that is used by the valuation team to understand and check if their calculations are correct or not, right? So what they try to do in analysis of surplus is they start with an opening balance, and they then try to split the movement of the opening balance to the closing balance under multiple bracket, like what is the impact due to new business, what is the impact due to mortality, what is the impact due to expense, what is the impact due to lapse, right? So that's how they try to, from maybe the opening balance is 100, closing balance is 200, so 100 to 200 is a 100 rupees movement. This 100 can be split into maybe 3 or 4 components that I've just mentioned, right? Sometimes exact match is not possible, so then there will be a figure called unexplained, right? And each company would try to keep the unexplained as low as possible, right? And when I'm talking low, it will be around 1 crore, 2 crore, right? Because the insurance dealing in much more higher revenues, right? So everyone tries to keep that very, very low, right? And there is still a chance, if the unexplained is low, there is still a chance that everything is wrong, because something in the positive side may be offsetting something in the negative side. That is still possible. That's why I mean, experience is required. That's why you need to do much more thorough checks. But still, analysis of surplus is the ultimate way by which insurer can check, or the valuation team can check, if the reserve movements is as per expectation, and it is tallying back with the reserve movement that has happened in the previous year, right? There should not be a drastic change, right? The strategy is planning, then do not change that drastically. So for that year, it may not be part of the opening balance, because suppose your year starts at April, 1st April, right, financial year, and this policy has come in 1st June, right? And after 15 days, maybe on 15th of June, the policy decided to cancel the policy. So the policy is not part of the opening balance, right? And the policy will obviously not part of the closing balance, because it has come on the books on 15th June, 1st June, and it is going out of the books on 15th June. So what it will create, it will create unexplained, because you are trying to track the reserve movement in analysis of surplus, reserve movement from opening balance to closing balance. In this case, it is not part of opening balance, it is not part of closing balance, it is starting somewhere, it is going out somewhere, right? But it is creating some movement, right? And because of that movement, there will be some unexplained. And that's how like most of the times what I've seen when I've done analysis of surplus is these are the policies: free look cancellations, not taken up. These are the policies that leads to unexplained, right? And although the number of policies would be less, but sometime you have that figure in your mind that it should be less than 1 crore, right? Because in the last 10 years it is less than 1 crore, the unexplained is less than 1 crore, and this time the unexplained is coming to be huge. And then you have to track back, okay, let me see year by year what policy is there. Then suddenly you see, okay, this policy is there in the opening, because you will expect all the policies that is in the opening and all the policies that is not there in the closing to get out of the system somewhere. But you will get some policy that is not in the opening, not in the closing, but in some 1 month they have pop up and then they have gone off the books, right? So in analysis of surplus, they causes huge unexplained, right? Sometime if the number of policies are very big. So that is one of the component that I want to kind of highlight. Another thing, or the liability will increase, right? Because as I mentioned time and again, that liability, there is no physical existence of liability. Liability is a mathematical number, right? So when you are Like when you are accepting a policy, your risk increases, right? So your liability increases. But because liability has no physical existence, so money has to be kind of taken from the asset, right? Especially from the free asset, the cash or the free asset that you have, and that would be invested in some regulated securities, right? Bonds and corporate bonds, government bond, bills, notes, etc. Right? So what will happen is the free asset will reduce. So and PNL means the change in the movement of asset and change in the movement of liability, like that the subtraction, that difference, change in movement of asset minus change in movement of liability. So overall, there will be no impact on equity, right? The profit is will stay the same, right? So this will offset each other, right? I think that is quite evident. So you are when you are setting up liability, your free asset is decreasing, right? So these two are offsetting each other. Also, any expense that is kind of incurred by the the insurer would be deducted from the premium, right? Because the premium is paid back, that I have mentioned. So insurer has incurred the expense and insurer is getting back the expense when it is paying back the premium, right? And obviously the last thing would be the premium that would be kind of deducted by the insurer, right? So the premium is the expense will be deducted by the premium, and the premium is paid back by the insurer. So overall, the insurer gets nothing. The insurer is getting on the premium that is paid back. Insurer is incurring some expenses that it is deducting. Insurer is setting up liabilities that increases that due to the setting of reserve, and the insurer is also reducing the free asset because of that. So overall, free look cancellation on a P&L basis, it does not have any impact on the insurer, but it does have reduction in the embedded value, and it does have the impact of negative word of mouth through mis-selling or other challenges, which is very detrimental to the insurer, right? So I hope this is clear how the like can the insurer cancel a policy, can the policyholder cancel a policy, and if the policyholder cancel a policy, what are the actual impacts, right? So I hope it is clear, and if you like this concept, please hit the like button. If you're seeing this for the first time, subscribe to my channel, share this with your friends. Thanks for watching, and see you in future videos.